Right. Well, I'll just introduce and tee up our session today a little bit. First of all, full and fair disclosure, our YouTube, so folks who aren't able to get here are able to see this, or you can go back, and I encourage you, if you want to watch it again, you can. But with that in mind, if anything you say may be picked up on the camera, so just keep that in mind. We've been doing these for, I'll say 10 years, give or take, and we've changed the format a few different times. I know that historically we've done this one at 8 in the morning, and we had gotten some feedback from a number of clients that if we had put it a little bit later, we might get a better turnout. And so that's why we tried with 9 o'clock today. So apologize if that threw anybody for a loop this morning, but on the flip side, I know we have more people that I haven't seen here before. So thank you for coming. The reason we typically do this the first week of the second month of the quarter is that, the quarter happens and ends March 31st. And then it takes about a month for all the meaningful economic data to be collected and measured and figured out. And so this has always kind of naturally fit well. By the end of April, we kind of know what happened in the first quarter. What's a little unusual today is kind of a lot has happened since the end of March. If you've watched the news, and if you haven't, good for you. The market has moved. So some of the data that we're presenting today is a little more recent than March 31st, but some of it, quite frankly, is stuff that only gets measured once a month or once a quarter. And so we just don't. So I'll kind of point that out as we go along. But we're going to talk about a couple of hot button items today. The first is we'll talk about the markets. We'll talk U.S. economy. We'll talk about some of the challenges that we're seeing in the economy. And then we're going to talk about, I want to talk a little bit about Social Security, and we're going to talk about the national debt and deficit. And the reason I'm covering those two topics is because there's been a lot spoken about them. And so I wanted to share what I think is relevant information, particularly to folks thinking about retirement when it comes to the federal debt and Social Security. And then we'll wrap up thinking about what's a good way to manage our resources and how should our portfolios be positioned and how do we manage through really challenging times. So with that, I'm Jim Dunlop. I'm the managing partner here. Chris Van Hart is also one of our advisors, and you've met some of our staff on your way in today. A lot of you know Jeremy Reed, one of our other financial advisors. Jeremy and his family just started an extra long weekend vacation here, headed to the beach with their little daughter for the very first time. So I know that they're anxious and excited at the same time for that. So and Jamie is our fourth advisor, and he is up in Camp Hill today. So there we go. All right. So just thinking about the three major indices, and this is through the end of March, and it's been even more wild since then. But the first quarter was a little bit of a step back. And quite frankly, we've seen that on and off over the last 5 or 6 years. We've seen a rough start to the year. So nothing terribly unusual necessarily in this, but S&P 500 is down 5.8%. And then the NASDAQ is down negative 8.2. And what I think is worth mentioning is that big technology companies, which have been very popular the last 2 years in terms of their growth, really took it in the teeth. And so the Apples, Amazons, Meta or Facebook, Google, those organizations really experienced a downturn. And so that gets magnified in the S&P 500 and the NASDAQ more than the Dow Jones Industrial Average. The Dow Jones is a broad-based index of 35 broad different industries, whereas the S&P 500 is cap-weighted, and so technology has eaten more and more of that pie over the last few years. And so when those big tech companies have a difficult time, we see it magnified in the S&P 500 and the NASDAQ in particular. So this is a chart that I show, and I just kind of, I like this because it gives us the perspective. This goes back to 1997. So not quite a 30-year time horizon here, but we've gone through several market cycles. And we're in the midst of something now, whether it's a correction or the start of a bear or bull market is difficult to know. But again, we saw the tech bubble here and it popped. We saw where am I? 2000, yes. And then we saw the Great Recession here and that popped and we saw stocks really fall. And then we've really had since 2009 this really incredible run. We had a big drop and step back, but we recovered reasonably quickly in 2020 from the pandemic. 2022, there was tremendous fear of recession, which never actually happened. And so we saw a pullback in stocks and then continued. And then we got to the beginning of this year and we got to the beginning of April. And all of a sudden, things were at all-time highs towards the beginning of this year. And we saw how much the market dropped. So where that far right green dot is, let's see if I can, there we go, right there, that green dot. That is where the market ended on April 28th. But you can see since the beginning of the year, it was down a great deal more and it was up a great deal more. Again, the other chart, and I'm not going to bore you with charts. I've done that before. This is the last chart. I'm pretty sure it's the last chart I'm going to show you. But what we're seeing here are three lines across the scene. And what we're looking at is the relationship between price and earnings in the S&P 500. So the long-term value of stocks on average is 16 times earnings. And so that middle line would say the 30-year average is 16.9, but even if we go out 80 or almost 100 years, it's around 16 times earnings. And so the top line and the bottom line are kind of one standard deviation away from that. And what we want to see is the good earnings relative to the stock price. And so when stocks get above that top line, we would say they're getting expensive, frothy even. And when they're below that line, we say they're very cheap. And on and off over the last 5 years, we've been living above that line that would say stocks are pretty expensive. And so we've seen the value stocks drop this year, probably just back into that range that we would say is normal or reasonable. But I just say all that just to say that, while as painful as it is to see the market gyrations, particularly over the last 45 days, really, it's for long-term investors, we want to stay in those lines. We want to see stocks grow along with earnings, because the stock prices go up, but the companies aren't making any more money, then you get a bubble. And consequently, if companies are growing and doing really well, but it's not evident in their share price, then we'd say they're pretty cheap and a pretty good value. So we want to kind of stay in that line. And so we're kind of back in there, but we're still at the upper end of that. So this correction probably was a little bit necessary. I think it's painful because it feels a little self-inflicted, but at the same time, we were getting to a place where stocks were getting awfully frothy, and meaning they were growing much faster than the companies themselves were growing their businesses. So again, we're going to continue to watch that trend going forward. So a couple of economic indicators. We just got this last week. We found out in the first quarter that GDP, which is the biggest measurement of growth in the US, actually shrank slightly. And so we saw that. A lot of that is I don't want to comment on why that is. Every politician will tell you a different story, but I think the story is people have more uncertainty on the future of the US economy right now, and that's starting to reflect. Inflation has come down, but it's not where it needs to be. So it's 2.39%. That's way better than it was 2 years ago, but quite frankly, it really should be closer to 2. And so is the Fed going to be accommodating by lowering rates if the economy shrinks? Or is the Fed going to keep rates kind of where they are, or even raise them if inflation takes off again? So again, we don't know. But right now, I think the Fed announces later today. I suspect they won't change their rate policy. I think it'll be less about what they set interest rates at and more about the outlook and guidance they provide in that press conference this afternoon. And then unemployment is still consistently low at 4.2%. We consider full employment historically in this country at 5%. So anything below that's perceived as good. And we got another really good job. This is conflicting data right here. The tariffs have created a lot of uncertainty. The fear of recession has increased dramatically across the board. And yet we got a spectacular April jobs report last Friday that surprised everybody, and the market went way up. So I think we're at a transition point, and I could stand here and make the argument that the market will go up and have a great year. I could sit here and make the argument that the market's going to go down because we're going to go into recession. We don't know, and you're seeing a lot of conflicting data, and so it'll be very curious. But these are important things I think to watch in the weeks and months ahead. Is where are we on economic growth? If we have another negative quarter of economic growth, that is often a big tell that we're headed in or already in a recession. But it's hard when we're adding jobs to the economy to say that we're in a recession. And that's because consumer spending is what drives our US economy. 70% of our GDP, so that GDP number we looked at, is based on consumer spending. We are a very consumption-based economy. And so if we look at these kind of 4 steps here that kind of go through this is, where is consumer confidence? What kind of disposable income does the consumer have? What are their spending habits look like? And that ultimately is what's going to drive GDP growth more than anything else. So that's why unemployment matters. When people feel reasonably comfortable they can get another job, they're more likely to spend. When people are worried that they can't get another job, or if they lose their job, they rein in spending. Right now, the initial outlook, consumer confidence has dropped dramatically over the last month. People are worried. We haven't seen the impact of the tariffs on the end consumer in a dramatic impact yet. But I think in the weeks and months ahead, we'll start to get a sense. So people are just really unsure right now. And I think, again, lots of conflicting data, but consumer spending is a very important habit and trend to watch, and consumer confidence, because it drives so much of the US economy. Another thing that's out there that's worth mentioning is the housing market and trends. Mortgage rates still are higher than they've been over the last 20 years, although I don't have to tell all of you that mortgage rates are historically lower than they were probably 30 or 40 years ago. Again, I've probably shared this with some of you. When my wife and I bought our first house 24 years ago, we were able to lock in our mortgage rate at 5.75. And our parents, both sets of our parents, looked at us and said, "Oh, you'd be crazy not to. That's the best thing we've ever seen." And of course, now, we look at 5.75 on a mortgage and think that's pretty high. But from a historic perspective, but that, as interest rates go up, there is some common wisdom out there. It says approximately every 0.25% the mortgage rates on average go up, it removes 2% of potential buyers. So for every increase in percent, 8% of potential buyers. When we saw 3% increase in the average mortgage rates over the last few years, or even 4 cases, that's a quarter to a third of the potential home buyers are knocked out of the market because of interest rates. So it's just something. And housing supply, again, remains very low. In this county, there is very, very limited listings compared to what we've seen historically. And there's still demand. And part of it is a larger trend of population growth. We have a lot of baby boomers who are living longer and are still very independent and healthy, and they're in their houses, and then their children have houses, and then we're seeing the baby boomers' grandchildren graduate from college and enter the workforce and want to buy houses. And so we have 3 big healthy generations, kind of 4 generations in some cases, still in the housing market. And that's just a result of demographics and people living longer and an older, healthier, retired group of people in this country. So all these kind of things and so housing is such an important part of what drives inflation. It's an important part of the economy. And so that is also an interesting thing to look at. So I want to talk a little bit about tariffs and geopolitical tensions, because there's a lot to have been said there. I don't know. I don't think anybody knows exactly where the tariffs are going to end up. And therein lies the problem. There are some that believe there's a grand strategy and goal in here. There are others that believe there is none. I won't comment on that, but I will say this: there is tremendous uncertainty. And in the periods of tremendous uncertainty, businesses tend to pull back and wait to make important capital decisions, important hiring decisions. And so that uncertainty has magnified itself in the market over the last 45 days, where we've seen days where the markets are up 1,000, the Dow's up 1,000 points in one day and down 1,000 points the next. And I think it's an interesting dynamic to pay attention to. And I'll say it this way, and I'll probably retouch on this towards the end of the presentation this morning, but the best and worst days in the markets tend to cluster together, and April has been no better example of that. And so we have seen some of the worst days in the last decade in stocks in April, and we've seen some of the best days in decades in stocks. So, just keep that in mind. And it's the argument that say, yeah, it drops a lot over this week, but then next week it might come back. We just don't know, but we do know the best and worst days, which is the hot periods of highest volatility, tend to cluster around each other. And we've been spoiled over the last few years. We've had years of very consistent, even market performance. The last 2 years in particular have been very, very easy. And even going back to 2017, 2018, 2019, those are very, very, consistent growth years in the market and not a lot of trouble or volatility. And so volatility isn't anything new, but we just haven't experienced a ton of it until very recently, outside of maybe the pandemic. So I think the tariffs and trade agreements could end up very good. This idea, this 90 days to negotiate. I think China is the big thing. The markets look like they're going to be positive today because the Treasury Secretary is now meeting with high-level Chinese officials to negotiate trade terms there. I think there's a lot of noise, but I think there's a lot of uncertainty. And if those trade agreements get worked out and we really get rid of most of the tariffs that have been announced, I think that could set the stage for reasonable growth in markets this year and add a little more confidence to the economy. However, if those things don't come to fruition, I think that creates uncertainty and certainly see things go the other direction. And I think we need to be very careful in how those things happen and negotiate. And you hope that you haven't offended anybody to the point where they're not willing to come to the table and negotiate and get things done. So we'll see. And then I think closely related to that is geopolitical tensions. I think the different things happening in the Middle East right now have not spread dramatically out of that region. But if the U.S. gets drawn into that conflict, if other big developing country or developed countries get drawn into that conflict, that could create uncertainty. Put all the tariffs and trade stuff aside, a larger global conflict, something happening in China and Taiwan. I think those are all things that would, if you think back to 9/11, even the Gulf War, times of great geopolitical conflict have really zapped confidence in the markets and in the economy. So, and then I think also there's currency fluctuations. We're seeing currencies move very dramatically. There have been periods of time in the last year where we've been in parity with the dollar has been very close to the euro, and then they're 20% apart. And those are huge fluctuations that we just haven't seen recently. And that can change the buying power of an American consumer just like that. So just those are different things to kind of be aware of and keep track of. So all of this is to say, I wish I had a good crystal ball and say it's going to be fine. And I think there's an argument for that, but I think there's also an argument that it could be a bumpy year. Taking a step back and removing trade and tariffs and geopolitical tensions and currency fluctuations, historically, the stock market is positive 3 out of 4 years and negative 1 out of 4. We go back over the last 50 years. The last 2 years have been very, very good. So statistically, there's a very high propensity that in the next year or two, we will have a bear market. We have one about on average every 4 years. Now, sometimes we'll have a 10-year stretch and then we'll have 2 years of bear market or 3 years of bear market and other years. So all this aside, the likelihood of some sort of market event has been increasing just by virtue of we've had 2 really phenomenal years. 2023, 2024 were very, very good years for stocks and to a lesser extent bonds. So I want to shift gears here and say, there's a lot of uncertainty in the economy, but let's talk about Social Security, because I think there's been a lot of talk and fear in the media, and I want to just kind of talk a little bit about some of this. So a couple of things to keep in mind. There's 70 million Americans on Social Security. In 2025, beneficiaries will see payments. The average Social Security person is collecting just under $2,000 a month. Women's economic participation is reshaping benefit structures. By 2095, 71% of women will receive benefits based on their own work history. You know, historically, there were spouse benefits. So there's a lot of stuff happening on the horizon that's going on. So there's been a lot of talk about the Social Security Trust Fund. And I'm just going to share this graph. At the beginning of 2020, we had 2.4 trillion in the Social Security Trust Fund. So Social Security Trust Fund came into existence in the 1980s. Ronald Reagan and congressional Democrats got together and said, you know, we've got this group of 30-somethings, baby boomers, and there's a lot of them, and they're going to go on Social Security. And so from 1930 to the 1930s to 1980s, all the workers in the system paid for all the retirees. And then, I know there's a lot of you in this room, baby boomers. They said, you know, we've got these people in their 30s coming through. We need to do something. So we started putting money aside in what was called the Social Security Trust Fund. We changed the retirement age from 65 gradually up to 67, so that anybody born 1960 or before, between 1946 and 1960, saw their retirement age go up a little bit. Maybe it was 66, maybe 66 in so many months, all the way to 67. So we did that. So that should get us to where we need to be. But the problem is that the Social Security trustees report projects that by 2035, the Social Security Trust Fund is going to be empty. And I think that always creates a moment of panic. It creates good headlines in the news. But here's the thing that I don't think always gets mentioned there. And this is second product. Current projections, the trust fund will be depleted in 2035. So that's about 10 years. But a few years ago, it's 2033. So it's a moving target. Benefits would have to be reduced by 20% without legislation. But what's missing in there is we are still able to pay about 80% of all benefits indefinitely. I hate to say it, but by 2035, baby boomers, some will start to die who haven't already. And so we kind of get back to this more normal population curve. And so all the people working will be able to fund 80% of all benefits. So the gap is we really have to figure that out over the next 10 years or so. We do need to figure that out, but it's not as much of a disaster as we might think. If Congress does nothing, yes, we'll wake up around 2035 and anybody collecting Social Security will take a 20% pay cut. For some people, they can deal with it. Others, that's a huge deal. I mean, you know, there's a lot of retirees who primarily live on Social Security. So there's some reform in the system needed. And there's a number of different solutions. And I'll just mention some of the ones that are discussed. Right now, we only tax the first $176,000 of earnings for Social Security tax. We could tax more earnings if we wanted to. But again, somebody that made $176,000 on average and somebody that made $2 million a year on average have the exact same benefit. So you can't get a bigger benefit on anything you earned above that. That's where we cap it out. But we could raise that cap. Or there's the idea of a donut hole and say, well, we're not going to tax anybody from 176 to $1 million, but if you make over $1 million, good for you, you're going to pay a little bit more. We could increase the retirement age generally beyond 67. So in 1938, 39, we started Social Security. The average life expectancy in this country was 64. We set the benefits to kick in at 65. It was not called Social Security at that time. It's called old age insurance. And it was if you had outkicked your coverage, you could get this. Well, it's shifted. People live longer, and it's an important part of people's retirement benefit. But we could say people are living longer, therefore, we could delay the age for younger generations. I'm a Gen X, so I think the millennials should retire later. But at any rate, we could change the benefit formula to weight it differently. We could change the cost of living approach. And, you know, so there's a number of different things that we can do to bridge that gap that aren't that hard, and Congress will get to it eventually. But you know, 10 years is forever when you have to get reelected 5 times between now and then. So most of our leaders, unfortunately, are not incentivized to look that far down the road and deal with it. And they also know that these different formulas to fix it are there, and at some point they'll take care of it. So I think we need to watch it and address it, but I don't think it's as huge of an issue as perhaps we've been led to believe. And I'm always the person who would say, boy, if we fixed it now, whatever the solution is, it's going to be easier today than in 8 years. But let's recognize that most politicians don't think with that time horizon, unfortunately. And then the other big thing I want to talk about is the debt burden. And I want to talk a little bit about this because there's a couple of different things out there, but this is another area of uncertainty that's down the road. This is not causing problems in the economy today. But at some point in the next decade, I suspect it'll show up. So let's talk a little bit about it. The past year it will be around $1.6 to $1.8 trillion deficit, meaning that in this fiscal year, which was October 1st of 24 to September 30th of 2025. So this fiscal year we're in, we will probably as a country spend about 1.6 to 1.8 trillion more than we'll bring in tax revenue. Now, it's just a guess because again, we haven't collected all the taxes yet and things change and whatever. I say that to say, and then the accumulated debt is around 34 trillion. And that's the accumulated deficit. So every year that we spent more than we brought in, kind of rack it, and then the interest on it compounds to some degree. Reinhardt and Rogoff, some economists have done a lot of research on this and said every 1% in debt reduces the growth rate by 200 to 300. But that becomes cumulative. If you look at GDP historically, it was at 3%. Was a good target. But if we really look at the last 25 years, our GDP has been closer to 2%. And I think that's in part because the debt is getting bigger and bigger and less manageable. It's one of these problems that Congress refuses to address, in my opinion. And I won't comment on the politics of the Department of Governmental Efficiency or DOGE, because that's been a hot button item, but I'll put this in perspective. They have claimed to have found $160 billion in savings. Great. We could all save money. However, that's 1/10 of what we need just to get, that's like 1 month's worth of deficit spending. That for all the pain and media attention that Elon Musk and that whole crew has got, it covers about a month worth of deficit spending. Like that's all that we've been able to accomplish. And so we have to fundamentally as a country address this in the next decade, I think, where it will be one of those things that really slows. We'll get bigger and bigger on this debt. And if interest rates go up, it'll be even more difficult and it'll eat more of that and that deficit will compound on itself. It is not impacting the economy today. It's one of those long-term things. And I share all this to say, I believe the federal payroll this year is $600 billion. Every federal employee is so we could fire every federal employee and we still haven't put a dent in the we still have $1 trillion more we're going to spend this year on top of that. So there are some big fundamental issues. I think we all agree there's waste in government and we see it, but this problem is way bigger than I think anybody recognizes. And it's one of those things that's so far out there that we're not really worried about it right now. But I think in the next 10 years, it could be something that becomes more critical. So it's one of these things that I wanted just to kind of give some context to. There's been a lot of talk about the government being more efficient, cutting out waste. And I think we all agree that should happen. I think we don't have much agreement on how it should happen or where we should cut. However, what we've done so far is really just a drop in the bucket and maybe covers us for 1 month. And we need to be thinking long term. And so, by 2050, we could be at 200% of GDP based on that outlook. And that could really increase our borrowing costs and people may not be willing to lend us money. So people still like American debt. It's generally regarded as the safest. And so we have a very big credit limit, bigger than anybody else, and we're using it. But at some point we have to address the way we're using it. And both parties, I feel, have blood on their hands. Deficits only seem to matter when I'm not in the majority. So I feel like we need to be focused on this. But again, like Social Security, it's one of these things that's still out there on the horizon that isn't showing up and impacting the markets today, is impacting this, but at some point it'll show up. And so it's just something to keep an eye on. I'll put that out there on the horizon for us. So, and the other thing is, if we don't address the debt, we'll lose our ability to have our shock absorber. So one of the things that kept us out of recession in 2020, when the economy shut down because of COVID, was massive government infusion of capital. The government had all these different programs. Some of them probably in retrospect were wasteful, some were not. They were, but it kept the American consumer buoyed and head above water, and we got through it. The government will lose the ability to do that in the future if it doesn't address its debt. So one of the beauties of being able to debt is say, hey, we can bail ourselves out as a country if we get into a very difficult situation, but we can't just do it every day. And so I think that's one of the risks, is that we get into a place where we have another major recession and the government isn't able to help. They don't have the ability or resource because nobody's going to lend them the money. So again, this is not something that Elon Musk is going to fix tomorrow, or any of us are going to fix, but there's a combination of growth policies, tax reform, rules, fiscal rules, consolidation, and it's going to require some sacrifice on the part of everybody. And at some point, we have to fundamentally, as a society, say, do we value all these programs over here, or do we value, we can't have low taxes and pay for all the other stuff. So I don't know what the long-term solution will be here, and I'm not trying to be dire, but I think at some point this will start to have a bigger and bigger impact on our economy. Right now it's not, but I think it's just worth addressing. But also, I'm encouraged that politicians are talking about reducing government spending, but we have to do way more than 160 billion just to get our heads back above water. So all of these different things in the short term and the long term do create market volatility. And so what do we do here, and what can you do? And I think there's two parts to this. One is the risk management part, being well diversified. I'm encouraged standing here today on May 7th that a lot of our clients' portfolios are slightly positive for the year or just slightly negative. We've seen, and that is the power of diversification. We use bonds in our portfolios. They've acted as a good shock absorber this year. Stocks have been all over the place. They're up one week, they're down the next. Also, broad diversification is really important. So good risk management is a diversified portfolio. I'll go back to what I said at the beginning. One of the things driving the market downturn has been a sell-off in big tech stocks. You've heard the Magnificent Seven. 7 or 8 of the biggest companies in the S&P 500, those are the 500 largest, are tech companies. They were probably very overpriced at the beginning of the year, and now they're probably back to where they need to be or getting closer to that in terms of good valuation. But lost in that noise is lots of other companies are profitable and doing well. And so having a broad, diverse portfolio right now is, yeah, maybe I didn't make as much because I wasn't all in those tech stocks, but by having that different over the last few years, but then they're such a volatile component. And then actively and strategically and tactically adjusting those mixes are really important. So our process, and the process we recommend to all investors, so they're working with us or not, is have clear goals on what the money's for. If this is money that I'm going to need to live on in 10 years, then let's treat it like that. If this is money that I need to live on next year, then it probably shouldn't be in stocks, and we need to be thinking about that. And then from the goals comes the appropriate investment strategy coupled with the right risk tolerance, so that we're not putting people in things that are too risky or not risky enough for where they are. And then making sure regularly monitoring and rebalancing that is really important. So we have a very data-driven approach here. We start with quantitative analysis, really looking at where good valuation and opportunities are. We think critically about the risk tolerance of each client, so that, again, as we build those portfolios, we're making sure that's appropriate. And then this idea of dynamic asset allocation. This is the idea of saying, hey, right now, we think this is an area that's undervalued. Let's make sure we're a little more heavy in that. here's something that's probably overpriced. Let's avoid that for our clients. And we can look at that by going back to where we started today, things like looking at PE ratios and looking at the earnings of these companies that we're investing in. Are they getting out over the edge of their skis, so to speak, in terms? And we saw a lot of that over the last 2 years. Yeah, the market was good, but there were companies people were betting would do even better than they actually have. And so I think that's just something to keep in mind. And then that a dynamic approach is adapting to the reality on the ground. What are economic trends? Well, right now, you've heard me say the trends are uncertain. We saw really good unemployment, feel good about unemployment right now and the jobs, which directly relates to the consumer, which primarily drives the US economy. That's a good part of the story. But then we see a lot of uncertainty about where the economy is headed. And so, we take a look at all these and we like to look at different investment opportunities. So things that we're really focused on right now, inflation risk is still there. I think that the idea, if the tariffs stay in some form, that will make things more expensive. That could increase inflation, and what impact will that have on the economy? We are also, what does I think if we start seeing the economy contract more, markets will sell off. And so a market downturn is certainly a risk that's present right now, as people are aware. And then, what's happening globally and both geopolitically and in terms of trade, and what impact does that have? So those are the things that we're kind of looking at, and our research partner is looking at, and that's where we are. So I think our takeaways here, we want to be strategic. We've been very pleased with how the portfolios have done this year, in part because these different things that we're doing. We want to be cautious of risk. We want to use market intelligence, and we want to look down the road. And it's a little cloudy right now, and that makes it a little challenging. But I'm encouraged by what we've seen so far, given how volatile things have been. So last but not least, here are some really important disclosures. And a couple of things that I'll point out is that the things shared today are simply our opinions and observations. That past performance does not indicate future results. And by the way, this will all be recorded and put on our YouTube, so you can go back and read this very carefully. And so defining some of the things that we've talked about today are also here. So with that, I want to kind of wrap up my formal remarks, and thank you for being here, and certainly willing to take any questions here in the last few minutes that remain, if anybody has any. Or not.
Jim,
Yeah.
I will speak economics.
Okay.
But it wasn't one of the many things I was So you were saying things happen in cycles. Once every 4 years.
Yes, in terms of a bear market. Yep.
But is that any thinking as you said you had a firm or somebody that provided analysis?
Yeah.
Are they looking for that correction again, or it's a difficult time to predict?
Right. It's hard to predict. I think the interesting thing about bear markets and when markets sell off is it's often it's the thing we don't know. And so it's the uncertainty factor. So I say that to say it this way. COVID's a perfect example. There was this talk of this disease that was coming out of China and in January and February of 2020, and we were kind of all like, "Oh, that's interesting." We've seen bird flu. We've seen, I think people were, at first, and then all of a sudden it became a big thing, and we saw markets within a very short period of time sell off, and and I use that example to say nobody would have been able to predict that the market would sell off because of a global pandemic. And I think that, so it's always the thing that catches you. It's the thing it's the unknowable that often causes the big market cataclysm. Go back to 2008, people didn't understand the way that so many companies were over leveraged using really bad mortgage-based debt, right? And so all of a sudden, we recognize housing can't increase by double digits every year. That's not a sustainable model. And, in retrospect, it looks very simple. Like, well, sure, we should have known this was going to happen, but we don't know it till it happens. And I think we live with that uncertainty. That's what's going to trigger the next market sell-off. And so I think the market has spent a lot of the last 45 days going, are the tariffs the thing, the trade war, if you want to call it that causes the market? Is that the thing that causes the market to sell off at this time? And so I think our analysis is thinking more about, we don't know what that next event is that's going to be there. And when it arrives, are we positioned in a way that our clients can absorb the shock of that? And so again, one of the things that made 2022 really frustrating and difficult was that stocks sold off because we were scared we're going into recession. Inflation was high. Fed raised rates very quickly. When rates go up, bond prices go down. They have this inverse relationship. And so 2022 was a year that was far more painful for investments than this year has been, which, we don't think of it that way, but it was in part because bonds had no shock absorber. And so it was very difficult to find good values and good investment opportunities in 2022, but we were still looking for them. And that's where we are right now, is making sure that we have broad based approach to different things happen in the economy. If interest rates go up or go down, what does that mean for this portfolio?
Right, I kind of consider myself a fat, dumb, and happy as far as my savings go.
Yeah.
I started investing, maxing out. I had an opportunity to start a 401k back in around 2000.
Yeah.
And I saw it grow.
Yeah.
But I always maintained a conservative approach.
Mm-hmm. Yeah.
Then that period between 2007 and 2008.
Mm-hmm.
This was a company that was CFC.
Yeah.
But then I would commute with my fellow two of the guys, and they were complaining, oh, we've lost again.
Yeah.
And I just was checking mine. I was fine.
And I think that's a good example of making sure of thinking about you have the right risk tolerance in your investments. If you can't stomach what's happening, that's probably a chance to stop and reflect on those investments. And I think your two carpool buddies, not to pick on them, it's stocks are very, very attractive when they have good years like they did the last 2 years, or have a 5 or 10 year run that's really positive. But if you can't take the loss, then that's tough. But if we look at where the market's been over the last 30 years at the beginning of this presentation, this is kind of a little drop in the bucket compared to where we've been even in the last 5 or 10. So,
Okay, thanks.
Yeah. I don't know if I answered your question, but it's a good reminder to make sure if you're having trouble stomaching what's happening to your portfolio, it's worth having a conversation.
I figure you're saying that we probably will stay away from a catastrophe, but it's better to do something sooner than later.
Yeah. And I think too, that the things, just to follow up one final thought here, and I'll go back to tech, not to pick on them, but a lot of analysts have said, these stocks are really frothy and expensive. We really shouldn't have a strong, yes, Apple and Google and Microsoft have grown tremendously. The power of AI, the speculation, all that has been a real boon to their stock prices. But at some point, those companies have to, whoops, my bad. At some point, those companies have to earn their profits have to increase as much as their stock has, or they're not really worth what we've put them at. And so I think that's, I think a good analyst and research partners looking at segments in the market that are overpriced and underpriced at any given moment. Because the thing that's most overpriced is going to get punched the hardest in the teeth, typically in moments like this. You're seeing that with those two. Any other questions? All right. Well, hey, thank you everybody for coming here. It's great to see all of you out. And our next one of these will be the first Wednesday in August, I believe. And so we'll look forward to doing this again. And if you really like this presentation a lot, you can come up to Mechanicsburg and have lunch with us at noon. We'll do it again.